Hello, everyone. Good morning to those of you dialing in from Europe, and good afternoon to those of you in Asia. Thank you to everyone for joining us for this webinar, in which we will be discussing Asia's energy transition and the financial case against continued investment in fossil gas infrastructure. My name is Jonathan Sims. I'm one of the senior analysts on the Power and Utilities team at Carbon Tracker Initiative. We are an independent financial think tank that carries out in-depth analysis on the impact of the energy transition on capital markets and the potential investment in high-cost carbon-intensive fossil fuels. I will be today presenting with my colleague Durand de Souza the findings of our recent report, Stop Fueling Uncertainty, Why Asia Should Avoid the LNG Trap, which explores the risks of gas infrastructure investment in Vietnam, Japan, and South Korea. I'll then be moderating a wider panel discussion on this topic, and for that I'm delighted to be joined by an esteemed panel of country experts. And in no particular order, I'd like to introduce Jacqueline Tao, who is an analyst with think tank Transition Zero and previously IHS Markit and Wood Mackenzie. Gahi Han, who is a research fellow with South Korea-based research house Solutions for Our Climate, and who formerly works at the UN Agency for Industrial Development and as a researcher at the Cybersdorf Experimental Complex. And Yuna Chang, who is a country manager with the think tank Influence Map and who formerly worked for the non-profit organisation, the CDP. Thank you all very much for joining the discussion today. We're delighted to have you all with us. For that discussion, we'd invite the audience to submit questions through the Zoom Q&A tool, and we shall do our best to put as many of those to the panel as time allows. But we shall start, as I say, with our scene setting presentation, and I'd now like to hand over to Durand to take you through the first half of that. So over to you, Durand.
Hi, everyone. Thanks for joining. I'm here to present on our new report, Stop Fueling Uncertainty, Why Asia Should Avoid the LNG Trap. This report was released this month. And it's all about the risks of investing in new and existing LNG infrastructure in 3 countries, in Vietnam, Japan, and South Korea. What we find is that LNG is an increasingly volatile and risky investment as a result of the fallout from pandemic and also Russia's invasion of Ukraine. And as a result, we believe that investing in particularly in new gas plants is particularly risky and will lead to increased consumer electricity prices, result in value destruction, and increased volatility risk. Instead, we believe that nations should seize the abundant renewables potential in these countries, particularly in the offshore wind sector. So I'd like to bring your attention to the graph on the right to begin with. The squiggly lines represent the price of LNG in Japan and in South Korea. As you can see, since January 2018, the prices have been relatively stable and relatively affordable. However, over the past year, we've seen a huge uptick in the LNG price. We've seen increased volatility, and in fact, the price has more than doubled from our baseline estimate, which is the average of the past 3 years. As a result, investing in new gas also has much higher costs than previously did. And we believe that these changes in the LNG market are here to stay, especially as Europe pivots away from Russian gas and begins to import significantly more LNG than it did in the past. So, as part of this report, we modeled new and existing gas projects in South Korea, Japan, and in Vietnam. We did this by building a techno-economic model and building a financial layer on top of that to then model project finance for all new projects. On the graph, I've plotted all of the new CCGTs in South Korea, Japan, and in Vietnam, as well as the estimated revenues of operating gas in 2021. So first thing to note is that Vietnam tends to have much lower electricity prices and also lower lower revenues to gas plants. This is because all of the existing pipeline and all of the existing plants in Vietnam are fueled by domestic gas, whereas in South Korea and in Japan, this is all imported LNG. Another thing to note is that if we just focus on the baseline estimates, which are given by the dark vertical line, we can see that many of the gas plants in these countries are approaching loss-making territory, even in under our baseline estimates. And I forgot to explain that the y-axis refers to the levelized cost of electricity of new gas, which is basically the total costs of operating a gas plant divided by the total amount of electricity generated across the entire lifetime of the power plant. And so the more electricity a plant can generate, or like the longer the lifetime, the lower the levelized costs tend to be, and vice versa. So if a gas plant is in the money, then the dot will be below the dashed line. And if we expect it to be loss-making, then it will be above the dashed line. So put simply, we expect that even under our baseline fuel cost scenario, where LNG prices have been are assumed to be in the average of the past 3 years, we expect that many of the new units in South Korea and Vietnam will likely result in value destruction. And this is primarily due to the fact that the majority of new gas will need to be fueled by new LNG investments. And in Vietnam in particular, significant new LNG infrastructure. However, what we can also see is that given the significant increase in the gas price over the past year, which now corresponds to the plus 100% part of the chart, even in Japan, where the market structure is quite favorable for new gas, new LNG fuel gas plants will actually also be quite risky investments and likely will be unable to break even. And ultimately, the bottom line is that we find there will be nearly $60 billion at risk under a business as usual scenario. This risk could materialize on the side of investors, or it could materialize on the side of electricity consumers in the form of higher electricity prices or higher taxes. So, as we all know, these 3 countries have also committed to a net zero by 2050 target, where they plan to phase out all of their existing fossil fuels infrastructure by 2050. What this basically means is that the vast majority of gas will need to be phased out by 2035 for South Korea and for Japan, and 2045 for Vietnam. And this is significantly earlier than a business as usual scenario, where a gas plant may operate for 30 to 40 years. And so as a result, we also expect the levelized cost of electricity of these new units to increase significantly, because they will have to amortize their financial costs over capital costs, over much shorter lifetimes. And as a result, we expect almost every investment to be now loss-making, unless tariffs and electricity costs increase significantly. So let's now talk a little bit more in detail about each country. I will talk about Vietnam and then pass it on to Jonathan to talk about South Korea and Japan. So as you can see, Vietnam has a very small operating gas fleet, which is fueled entirely by domestic gas. However, it plans under the new power development plan, a 5-fold increase in gas plants, about half of which is then going to be fueled exclusively by imported LNG. As a result, Vietnam will need to invest significantly in new LNG infrastructure, including import terminals, pipelines, regasification, and so on. And in fact, we do not actually include these costs in our levelized cost of electricity estimates. So with the gray bars, you see the levelized cost of electricity of new gas over the coming decade. And in the colored lines, you see the levelized cost of electricity of the alternatives, which in this case are solar PV and onshore wind. And what we find is that even by this year, new solar PV and new onshore wind will be cost competitive with new gas plants. And if we then also include battery storage, we find that this is true by the end of the decade. And this is assuming a very conservative base case fuel cost scenario. And given that, fuel LNG prices have increased significantly already and are likely to remain significantly higher than our base case, we expect that these years will be brought forward pretty significantly. So ultimately, we really want to highlight that Vietnam should avoid the LNG trap, avoid investing in significant new gas infrastructure, and instead focus on clarifying their PPA contracts and building their renewable industry. Okay, I'll pass it on to Jonathan now.
Thank you, Durand. So yeah, I'm just going to take everyone through the last remaining slides here. And if we first turn our attention to Japan, you can see on the left-sided bar chart here that the country has a well-established gas power sector with just over 75 gigawatts of capacity operational. And this compares with a relatively small 10 gigawatt pipeline of new capacity, at least compared with Vietnam and South Korea. The Japanese government has set an ambitious target of cutting LNG-fueled gas plant share of the power mix to only around 20% by 2030, and to have a system predominantly supplied by clean energy sources by that same year. And for Japan, reducing exposure and dependence on the volatile LNG market is much more a case of planning its phase out of existing power sector gas use in line with its 2050 net zero target, rather than addressing a giant pipeline of new build capacity. That said, however, the economic outlook for building new gas in Japan remains clear. And as we show on the right-sided chart here, that new units become uncompetitive on a cost basis with both new onshore wind and solar by 2025, and with solar with storage by the end of the decade. New solar with storage is also then projected to become cheaper to operate than the average cost of running Japan's existing gas plant fleet during the early 2030s, meaning that the country will have a low carbon energy source able to provide comparable flexibility services to gas units within a decade. Next slide, please. For South Korea, as you can see on the left-sided chart here, the country has more than 40 gigawatts of capacity already operational, but then a pipeline equal to just under 50% of current capacity planned to be added to this. By contrast, South Korea's renewables capacity is alarmingly low given the size of the country's economy and its net zero by 2050 target, with renewables in even very recent years having accounted for less than 10% of the country's power generation. South Korea has a new government due to take office next month, however, following elections in March. And we believe that this is the perfect opportunity for the incoming administration to focus its future energy policies around rapid renewables deployment, which continues to represent the most cost-effective path to net zero emissions. And as you can see on the right-sided chart here, even solar power capacity with battery storage is projected to become cost competitive with new gas in South Korea by just 2025, and then with the country's existing units during the early 2030s. New standalone solar, meanwhile, is already cheaper to build than new gas in South Korea. Next slide, please. And just finally, for this research, we introduced our levelized cost of energy projections for offshore wind technology, which we believe will become a central component of future energy systems in Asia. And as shown on the chart presented here, with offshore wind development costs shown in the red, black and blue lines, and the range of new build gas costs represented in the green shaded area. Offshore wind farms in Vietnam are expected to become cheaper investments than new gas plants by the late 2020s, while offshore wind costs in South Korea and Japan are then also expected to become cheaper than the average new build gas unit during the early 2030s. The lower starting point for estimated offshore wind development costs in Vietnam is explained by simpler logistics there, with inland access and further afield, meaning that materials can be delivered by road transportation, which is a luxury that Japan and South Korea do not have. While in Japan particularly, the starting point for offshore wind development costs is lifted by deep seabed conditions. We believe, however, that given the maritime expertise and high standard of port facilities already in place in Japan and South Korea, that costs could come down sharply once the first few projects are delivered. Both the Japanese and South Korean governments are targeting rapid growth in this sector already, with targets of 10 and 12 gigawatts by 2030 respectively. And this is from a starting point of just a few hundred megawatts currently. For Japan, our mid-range scenario estimates shown here account for the Japanese government delivering a target of driving down offshore wind investment costs to around $85 and $75 per megawatt hour by 2030 and 2035 respectively. But we believe that even these could represent a rather conservative outlook for the rates at which costs might fall, given that offshore wind farms are already being developed in Europe at cost levels of only around $80 per megawatt hour, while globally the average for the technology has already fallen below 95. One Japanese project developer, incidentally, has already accepted a power purchase agreement at a price of only just above $100 per megawatt hour, demonstrating how quickly costs could come down under certain market conditions in Japan. So that concludes our scene setting presentation and key findings from our recent report. Please do reach out to myself or Durand if you would like to further engage with us over the report findings or data modeled for this project. But I'd now like to begin the wider panel discussion by inviting each of our esteemed guests to make an opening statement on the subject matter of Asia's energy transition and the case against the continued long-term use of gas there. So I'll first hand the floor to Jacqueline from Transition Zero.
Right, thanks, Jonathan. Good morning, everyone. My name is Jacqueline, and I'm an analyst at Transition Zero. Before I start, I'd just like to extend a huge congratulations to Jonathan Durand, as well as the whole of the Carbon Tracker team on the release of this incredibly important report. Natural gas has been heralded by many in the region as the fuel of choice to power the region's next wave of economic growth. This has really been reflected in really strong estimates or forecasts of LNG demand growth in the region. So the latest forecast from Wood Mackenzie actually see Asian LNG demand expand by around 40% by 2030, growing from a relatively high base already of 270 million tons in 2021 to 318 million tons by 2030. So if you want to put it in gas generation terms, this roughly translates to the region adding around 12 gigawatts of base load gas generation per year, and that is kind of equivalent to adding 1/5 of Japan's gas fleet that will run on base load every year. So this expansion of gas generation is, broadly inconsistent with any global climate ambition that we're talking about. So if we align ourselves to IEA's net zero scenarios, we will probably need to see gas generation drop drastically by 2040, maintaining its use mostly as balancing or to serve, just as peaker plants instead of baseload plants to stay within 1.5 degree warming. So it is incredibly important right now for Asia to take a step back and take stock of where we stand on gas. And this is why this report is incredibly important to help shift the narrative and shape ongoing discussions on the role of gas generation in powering Asia's energy demand growth in the coming years. So I'd like to take the rest of my time to quickly offer some of the updates that's been happening around the region. I'll probably want to start with Japan. which experienced one of its worst challenges to its power system just a while back. So that happened, I think, around a month ago, where one of the earthquakes hit Japan's northern part, and it brought down a fleet of around a dozen turbo plants along the way. So it was an unfortunate timing because it coupled up with a period of really unexpected cold weather spells just as Japan was entering, spring. So what happened then was reserve margins in areas such as Tokyo and Tohoku were extremely, extremely tight. This has prompted Japan to issue its first electricity supply warning, urging the public to actually cut down supply while pulling up all the stops in terms of getting any excess, cutting demand, requesting public to cut demand while pulling all the stops and asking the utilities to bring out any additional marginal supply that they have. So Japan was able to avert the near crisis, but there are actually longer term impacts of the crisis. So some of the power plants, they are actually going to take months to resume operations. And this means that Japan will really have no choice but to bring expensive spot cargoes in the near term to meet this demand gap. And in terms of spot cargoes, we are really seeing JKM prices, which is the Japan Korea marker prices assessed by Platts, go up to ridiculously high levels. I think it exceeded the $80 per MMBTU ceiling just recently. So what this episode really highlights is, the issue of energy security, not only for Japan, but for any other country who's looking at, using imported LNG to power their power fleet in the future. And is this volatility in spot term LNG market something that they can tolerate? And then if we move on to focus on Vietnam, there's actually quite good news. Vietnam has released its latest draft of the PDP, I think this Monday on 18th of April. So this this draft comes after months of reviews and different drafts that saw increasingly tightening climate-related commitments. And this PDP actually had headlines that read that, they're going to stop building new coal plants in this planning phase, and they're going to shift away from a reliance on fossil fuels or gas. But even then, I think it's important to keep an eye out of what Vietnam's plans actually mean, and we'll be keeping an eye out for that. Another point that we'll be keeping an eye out for Vietnam is definitely a potential pivot back to domestic gas. So domestic gas in Vietnam hasn't been really that much talked about in recent years, particularly since a lot of its projects, planned projects, are actually put on hold or stalled for many of years because of high cost of development that makes them uncompetitive against cheaper LNG. But now with the economics flipping, and I think it's important to keep in view out for the impact of Vietnam's domestic gas potential vis-a-vis its role that it will play in the power sector. This is particularly the case because I think Vietnam's existing gas resources and future gas resources, they're actually really high in terms of CO2 content, and that excess CO2 is typically flared, which really adds to its climate footprint. So this is something that we're gonna keep our eyes out in terms for Vietnam. So I think that's all for my time, and I'll hand over back to Jonathan.
Thank you very much, Jacqueline. Some really key points raised there. Great way to start the panel discussion. Gahi, would you like to come in next with your opening remarks?
Sure. Thanks for the introduction. And my name is Gahi Han from Solutions for Climate. We are think tanks, advocacy, and campaign groups based in Seoul, in South Korea, and I'm working as power market grid and team leads. First of all, I would like to thank CTI for inviting me to this event and for sharing these remarkable findings. I hope we will be able to utilize this research to amplify our message and convince Korea's new administrations to first cancel all the existing plans to switch from coal to gas, and second, to reform the current outdated power market system in a more renewable-friendly way. Because even though it's projected as CTI shared before, that new renewable project has been becoming economically competitive with new gas power plants. The reality is that multiple Asian power market system is not reflecting this trend properly. For example, South Korea's power market system is being dominated by its state-owned utility called Korea Electric Power Corporations, also known as KEPCO. And just as similarly, Vietnam has EVN and Japan used to have KEPCO and other utilities monopolizing the system. So in Korea, KEPCO owns 100% of the transmission and distribution network and is the sole electricity buyers / retailers. And also it produced around 70% of national electricity through its subsidiaries. The thing is that under this monopolized power market system, the total cost plus a certain level of profit margin are guaranteed to be fully recovered for gas power plants run by KEPCO. However, fuel costs are high or operating hours are low. Therefore, there is zero risk in constructing and operating new gas power plants for KEPCO's subsidiaries. And of course, this has enabled them to make such a rash decision of replacing a massive capacity of retiring coal power plants with new gas power plants. Okay, and this is why Korea has been exposed to such a high stranded asset risk from new gas power plants. And besides, I would like to also share that according to SFOC's oil and gas report, Korea's public finance has been providing an average of nearly $6 billion per year for gas projects globally, scoping from upstream to downstream. So these assets also seem to carry its potential risk of being stranded. And no wonder the burden will be eventually passed down onto the electricity consumer and public. Okay, I'll just say this issue seems not to be limited to Korea's case, but more like it's something that any Asian countries having less liberalized market and monopolized system can experience in near future. So this is the problem I was saying, and just adding one more point to that, the problem is not only high stranded asset risk itself, but also the fact that this market system has been delaying the deployment of renewables in South Korea. But I think I will stop here for now, and I will be happy to address more about how this system is being a roadblock to renewables, if relevant discussions is brought up. Thank you.
That's great. Thank you, Yahi. Some very personal remarks there on the situation in South Korea. And yeah, I think we'll come back to the topic of market design there shortly. But Yuna, I'd like to invite you in now for your opening remarks.
Sure, thanks, Jonathan. Yeah, I want to echo the other panelists' remarks. So thank you for inviting me, and thank you for an incredibly compelling report. And I feel like the other panelists have expressed it well, but I found it so interesting how you made kind of a case, not just against gas, but for renewables. So the idea of cost competitive solar, offshore wind opportunities, and going into this in detail in the presentation and the report, it just kind of showed a positive future pathway that I think will have a lot of resonance in future discussions. So thank you so much. And yeah, I guess I wanted to add a perspective to add to what the panelists and Durand and Jonathan have said about there is now a clear financial case for renewables over that of fossil gas investment, and especially in new infrastructure. So I wanted to kind of add the perspective of how energy policy impacts that, and how those who are influencing energy policy can have a huge impact on Asia's energy future. And Jonathan did touch on this in his presentation, but especially in centralized power market systems like in South Korea, as Gahi mentioned, but also Vietnam, energy policy is the backdrop that kind of sets the ceiling and floor of what is possible in terms of investments and planning. So to kind of quickly take a step back and introduce Influence Map, we're a think tank based in London, but with offices globally, and we track and assess companies and industries' climate policy engagement activities, scoring them based on how their policy positions are aligned or misaligned with Paris Agreement goals. And looking at kind of Asia's energy markets, we see for all three countries mentioned in Carbon Tracker's report, there are powerful industry voices that are opposing more ambitious climate policy and energy policy that could push the needle forward on rapid renewable investments. So just to quickly illustrate, for example, in Japan and South Korea, some key industry sectors are very vocal against climate regulation and renewable energy policy. Some of these sectors include heavy industry, such as steel, utilities, energy companies, and these are often companies that have ambitious operational targets or support long-term 2050 climate targets. But we found that kind of consistent policy engagement and advocacy to government from these companies is holding back more ambitious renewable energy policy. And these are companies that have huge shares in the economy and have very influential voices in policy-making discussions. So I think, when we're talking about the financial case for rapid transition to renewables being there, we really need to also think about what might be stopping that policy being written in and really being prioritized. Having talked about the negative side, I also want to raise that, on the other hand, the power of policy engagement by industry can be a huge enabler for positive policy. So in Japan, for example, we're seeing JCLP, which is the Japan Climate Leadership corporate group, kind of speaking out more to push their government to prioritize renewables and energy policy. Similarly, in Korea, there are more companies signing up for initiatives like RE100. And once they sign up, they realize, we need the enabling energy policy to be able to procure 100% renewable energy. So I think there's a lot of good signs around that. And then lastly, I don't want to take up too much time, but on Vietnam, I think from the presentation, it really stood out as a country that has very little existing gas infrastructure and could feasibly leapfrog from coal to solar. So at Influence Map, we have an upcoming report looking at the policy engagement activities of actually Japanese and Korean LNG industry players in Vietnam, who are big kind of foreign direct investment players, and what they might be doing to push the needle on energy policy in Vietnam. So Jacqueline mentioned PDP-8, which sets the kind of energy mix and long-term energy plan for the next 10 years. And we found that Japan and Korea, Japanese and Korean industry has actually unfortunately been pushing for more LNG investment in that power development plan. So illustratively, after there was a reduction in LNG projects in the PDP-8 following the COP26 announcement of net zero and these incredible targets announced by the Vietnamese government, Japanese and South Korean industry was going in asking for the LNG projects to continue to be included and not delayed. And that has a huge impact on the kind of long-term energy mix for Vietnam. So yeah, that's what I wanted to raise, but also there are positive voices in Vietnam from the foreign direct investment community. So for example, the European Chamber of Commerce has pushed for more ambitious renewables investments. They are strong advocates for offshore wind. So I think amplifying those positive industry voices and kind of encouraging that groundswell of a positive voice for energy policy is a real priority. And I think Carbon Tracker's report is going to be really helpful in that. So thank you.
Thank you, that's great. Before we go on, Duran, do you have any responses to anything that was mentioned during those opening comments, or anything you'd like to add at this stage?
Yeah, I guess it's really helpful to hear the context from the panelists. And in particular, I guess I want to go back to Gahi's point about how in Korea gas plants are, in the money by definition, especially if they're owned by KEPCO. And I think that's a really important point, because while this may enable them to invest in new gas and invest in a risk-free way, there is still risk in the system. It's just that the risk is now materialized by electricity consumers and by taxpayers instead. And as we've seen, as has been mentioned already by Jacqueline, the LNG prices have skyrocketed. I didn't realize it was as high as $80 per MMBTU, but there is basically significant increases happening over time. And I think if you invest in a new gas plant, you have to be aware that these pass-through costs are going to be paid by electricity consumers. And all of these three countries are basically industrial powerhouses, and higher electricity costs are going to inevitably result in higher costs to their industries and to electricity consumers as well. And that has knock-on effects on the wider economy. So ultimately, there is always risk. It just depends on who's going to be paying for that. I think I'll leave it there for now.
Okay, great. Thank you, Duran. That's very clear. We've got some questions coming through from the audience now. I'll come to those shortly. But if I can just return first to you, Una, and the topic you alluded to of the barriers that are preventing renewables deployment from not coming any quicker in these parts of Asia, because the economics are becoming clear now that renewables are cheaper to build than new gas over the course of plant lifetime. So what more can and needs to be done on the policy side to stimulate the levels of investment required in the renewable sector? Is it subsidies, or is it something else?
Yeah, thanks, Jonathan. I think often, there are some really incredible kind of climate targets coming out, and I think more and more energy policy is being driven by those net zero targets and things like that. But I think the barriers are clearly kind of entrenched industry voices that kind of have captured the policy agenda and are preventing kind of perhaps more imaginative and ambitious thinking around what can be done. And I think something to really look at when trying to explore different policy options is looking at the narrative capture by industry as well, around this supposed need for gas. So Jacqueline mentioned, which I really like, that gas has been pushed as the fuel of choice in Asia, but actually I think looking at kind of industry tactics to look at, for example, how gas has tried to be pushed as an inevitable policy choice for these countries that we are talking about is really important. So, for example, in our upcoming report, we look at how the LNG industry has looked at or pushed certain strategic messaging around fossil gas and LNG. This includes kind of repeated use of narratives like gas as a bridge fuel and essential for the climate transition, and alternative to coal. Gas is the only solution for rising energy demand in Asia, especially Vietnam, and also gas as the only fuel that will allow continued economic growth while transitioning away from coal. And I think that really kind of limits the policy discussions that are being made, because this consistent strategic messaging by industry makes it seem like that you have to work within these limits, but actually having these new reports from Carbon Tracker and other entities and saying that this is actually not the prevailing narrative, does not speak to the economics, and integrating them more into policy discussions, I think is really key at this point.
That's great, thank you, Una. I totally agree. I think particularly in Vietnam, yeah, the opportunities there for coal to clean transition must not be missed, and we need to see those policies coming forward to deliver that. I think related to this issue and the barriers preventing accelerated renewables deployment in Asia, I think is the fact that, as Gahi said, some power systems in the continent continue to be designed and structured around fossil fuels, and particularly the case in South Korea, where, as Gahi said, we have a power system designed to favour certain technologies and certain utilities. So Gahi, perhaps you could speak a bit further on how that system structure has slowed or prevented greater renewables penetration, and what needs to be done at the system level to accommodate more renewables.
Yeah, thanks, Jonathan. And yeah, I would say, as I presented previously, our Korea's power market system is dominated by one state-owned utility called KEPCO, and we think this system also has been delaying the deployment of renewables. In Korea, most of KEPCO's subsidiaries assets consist of fossil fuel-based power plants. So no wonder they are not so welcoming bringing in some flexible resources, which is necessary technologies to expand renewable while maintaining the security of power supply. Because it would probably help push KEPCO's existing assets out to be stranded. Therefore, Korea is seeing the situation where more than necessary gas power plants remain on the grid, competing against renewables. Jeju Island is a prominent example of this phenomenon. Jeju grid makes up around 2% of our Korea's total grid capacity, and it had announced carbon-free island initiative around 10 years ago. In 2021, Jeju, solar plus wind power together takes up nearly 20%, and gas or oil power 50%, and the rest is coming from the mainland. So 20% of renewables are not quite enough, like far off from being the dominant resource for the Jeju power grid, but Jeju already started experiencing a dramatic curtailment in renewables. And this is because even if this can be resolved, if we introduce like infrastructure such as batteries or virtual power plants, so to make Jeju's grid more flexible to accommodate for more wind and solar. However, instead of bringing in these technologies, Jeju's power market is still keeping a huge capacity of gas power plants owned by KEPCO, and some of them are being labeled as must-run power plants, meaning that to maintain the power grid stability, this fossil fuel must run. To summarize, Korea's monopolized power market system are not reflecting the global trends, where renewables are rapidly growing along with its increasing price and competitiveness, and also resulting in a delayed transition towards a fair power system to renewables. So I'm trying to just repeat my point that I think this can be also the case for other Asian countries, and where has the monopolized power market system. So I would say it's very, very important to unbundle the system. So we just opening market to see more competitions coming in, and like necessary investment for renewables are just being in place in time. Yeah.
Thanks, Gahi. No, there's some very interesting points there, and I think it will be fascinating to see how the South Korean power system does evolve over the coming years under the incoming government. I'm going to change topics slightly here and take things back to one of the key discussion points we focused on in our earlier presentation, and the extreme levels of commodity price volatility that future gas infrastructure build is exposed to. We've seen gas markets globally spike to record price levels in recent times, and supply struggle to keep up with huge swings in demand either side of the pandemic. And then to exacerbate things, the Russian invasion of Ukraine and the repercussions of that have shown how quickly geopolitics can alter market supply dynamics. So I'm going to turn to you for this one, Jacqueline. And my question is, although some fossil fuel investors may see recent events as short-term commodity price drivers that you can, to a certain extent, protect against through hedging strategies, surely this volatility highlights the extreme levels of risk that such investments are exposed to, and which nations can only really end their exposure to by transitioning to a clean energy system.
Yeah, Jonathan, I think you're definitely right in saying that, a lot of the investors don't really see this short-term price volatility as impacting their long-term investment decisions just because of like different investment horizons. And in fact, this kind of short-term price volatilities, they're very seldom built into financial models that back this kind of investments. They're mostly viewed as like a side afterthought, maybe built into, for example, sensitivity analysis when they have the time to, but never really taken very seriously. And I think the general understanding is that, this kind of short-term fluctuations, they're actually just noise in the longer term, and eventually the upsides and downsides, they'll cancel each other out, and then it's like, okay, BAU, business as usual kind of circumstance. So there's no point in taking them into account. But I think there's more and more evidence suggesting that actually climate change is actually shifting the balance of risk. And the way that I kind of think about it is that climate change impacts will likely manifest in like more and more price volatility, and actually increased frequency of this kind of short-term price volatility due to energy transition risk, as well as the physical risk of climate change. And if you want to think about it, the first layer of impact actually definitely comes from the climate transition risk. I think it's increasingly clear that banks are wary of investments in the upstream sector for oil and gas projects, such as the liquefaction plants, the downstream regasification plants. And I think it's safe to say that gone were the days where the banks will just lend freely to any oil and gas project that comes to their way, guaranteeing 10% returns. Kind of investments. And what we are likely to see in the coming decades, or the world that we're entering into, is actually a world where gas or LNG supply is very, very tight. It's balanced on a very tight margins, and that makes it very prone to price swings in response to unexpected demand changes. For example, like an unexpectedly cold winter that increases heating demand, or any supply shocks that comes along the way, and which we have seen a few of the upstream liquefaction projects are pretty prone to. And then I think the second layer of impact definitely comes from the physical climate risk on any kinds of infrastructure, LNG or otherwise, upstream in terms of oil and gas, downstream in terms of power, as well. You've seen in Japan as a way of that, how that is going to be manifested in the future as a result of climate change. So what this means is that in a very tight market, we're going to see demand swings that's going to happen more and more frequently. So we're entering a market that spot LNG prices are only going to be more volatile, more unpredictable, and there is clearly not too much upside, or the counter argument against it. Very few chances of that happening. So what this means is that there is a clear financial impact on current and future LNG projects, and that is subject kind of to the varying exposures of power projects to spot LNG prices. Traditionally, I think Asian utilities prefer to pay higher for security, so they actually have very much lower exposures to energy prices. So you can see that disjoint between JKM spot markets versus what's the landed cost of LNG in Japan, and we see that similar case in Korea. But then the key most of the LNG contracts in Southeast Asia and in Asia, they're actually oil indexed. So we see that same kind of impacts on oil maybe not to the extent of LNG, because LNG is traditionally more volatile, but we see the same impacts as well. So we're going to see a tighter market for LNG, and LNG is going to be pricier because, you know, if you're signing a new LNG contract now, we're not going to see lower indexations like 11%. We're going to see 14% indexation, which is really expensive. So what we're seeing in terms of long-term impacts is definitely something to keep into consideration. And it's no longer safe to say that short-term impacts don't manifest in long-term investment decisions. Yeah.
That's great, Jacqueline, very clear. Durand, you touched upon this during the presentation, but I guess given the points that Jacqueline raised there, would you like to comment further on the risks to domestic energy consumers of further gas infrastructure build in Asia and the comparative benefits that the increased renewables penetration in the system
Yeah, I think
brings for them?
I think Jacqueline made the point really well. So I don't know if I have much to add, but I guess I want to just, you know, amplify that point. When you build a new gas power plant, especially one that's fueled by imported LNG, you are essentially like increasing the volatility risk of the market, because you're now reliant for your electricity needs on a very volatile global market that, you know, if you instead invested in offshore wind or in solar PV, or even with battery storage, this wouldn't be the case, because in the case of offshore wind, for example, you would be building a new wind turbine and you're locking in the price of that electricity at the point of construction. While in the case of a new gas power plant, you have no idea what these costs might be. It might be, you know, affordable today. It might be incredibly expensive tomorrow. And, you know, I think this uncertainty is a big problem, especially for emerging economies, where investors really need that certainty to invest in the country. And I think, you know, to further amplify this risk, we have to take a look at also at the supply chain of LNG. In Vietnam, for example, there is a need to build new, you know, regasification import terminals across the country. There's a need to build new gas pipelines. And, you know, on the legal side, there's also a need to construct contracts for all of these different components, for the import of gas, for the, you know, to operate terminals, to operate new gas plants. And I think all of these different components need to actually materialize effectively at the same time in order for, you know, a foreign investor to actually be able to comfortably invest in the project. And I think there's a lot of uncertainty here in this planning process and well, inherent in the infrastructure itself. And this is something that we wouldn't see with renewables in the same way. I think I might also address Ken's question here. So Ken asked about whether there's, you know, a kind of timeline for decisions regarding regasification terminals. I think that's actually a very good question, but, you know, as is often the case in Vietnam, there are ground plans embedded in the, you know, power development plan, but these plans are not very certain at all. And over the next decade, there are plans to, you know, build, I think, something like 60 gigawatts of new gas, over half of which will be from imported LNG. But the plans to build these new import terminals to fuel these plants are completely uncertain. There's basically no financing agreed, and many of the contracts are still yet to be signed. So I think, again, it really highlights how uncertain things are for the country and how the alternatives could be much clearer, much simpler, and, you know, easier to build in a piecemeal way. Thanks.
That's great. Thanks, Durand. So there are a couple of other questions coming from the audience, which I might circulate to the panel now. There's one addressed to Yuna and Gahi. South Korea is one of the biggest producers of LNG tankers globally. Do you find significant evidence of lobbying by major industrial engineering and shipbuilding companies in South Korea to protect and grow the LNG market, both at home and abroad? And to what extent are industrial companies restricting policies to enable faster renewable growth? Gahi, should I go to you for that one first?
Sorry, can I take a minute?
Of course, yeah. Una, do you have any thoughts on that?
Yeah, sure, I can address that. So on the first question around LNG tankers and the use of LNG for kind of maritime transportation. In terms of our report, we've only really looked at the LNG industry's policy advocacy around power, LNG for power. So I can't really speak to that specifically, but we have in our wider research detected kind of narrative building around LNG as a kind of clean fuel for shipping, and there's lots of policy advocacy from shipping and shipbuilding companies at the International Maritime Organization as well, which sets those kind of regulations and kind of, yeah, growing that demand. And then in terms of the second part of the question about, I think it was about kind of how industrial companies in Korea impact renewable energy policy. I mean, yes, it does have a huge impact. So just to take the most recent kind of policy kind of decision made by the outgoing South Korean government, which revised upwards the NDC 2030 target for GHG emissions reductions to 40%, and also kind of raised the renewable energy target. So for 2030, there was heavy opposition from South Korean industry, and this wasn't just through individual companies, but fueled through industry associations. So, for example, South Korea's biggest industry association, cross-sector, the Korea Chamber of Commerce and Industry, headed up by the chairman of SK, Chuk Tae-won, was extremely negative around the upwardly revised GHG emissions target. Said it was unrealistic, that it needed to be reconsidered. Energy industry and utilities have said that renewable energy targets threaten South Korea's kind of economic growth and energy security. And these industry associations have powerful voices because they claim to represent the economic sphere. And so they have a huge influence on how policymakers make those decisions, because they're giving the whole industry perspective. As I mentioned earlier, that doesn't represent the whole of South Korean industry. There are positive voices that are being drowned out by a very vocal minority. So to the point where most recently industry associations in Korea asked the president-elect to revise down Korea's 2030 NDC target. So the asks are getting more explicit, more vocal, and it really does sway the kind of public argument about feasibility of renewable energy policy, because when there's constant opposition to it, it suddenly seems maybe it's not possible. So yeah, I would say there is a huge kind of capture of the policy conversation in Korea by industry in Korea. Yeah.
Thanks, Una. Jacqueline, we've got around a minute left if you'd like to come in on this one as well.
Yep, I can talk quickly about, the potential for, industrial players to have a view of what's happening. So you're definitely right in saying that South Korea has a very big, shipbuilding industry. But I think the counter argument is also that it has a very strong E&P or EPC companies, big names like SK, GS. They actually have a potential role to play in terms of offshore projects, because a lot of deep sea structures or offshore structures are actually very similar. I've spoken to some of the EPC companies in the region, Thailand, Southeast Asia. They are actually earnestly looking forward for the project pipelines for offshore projects, because they see a way or a potential for them to come in and provide the expertise that they can provide. So I think there is also an argument there that the EPC company, if they're looking to shift or find a role for themselves in the energy transition, this is definitely an area for them to really strive. And changing the narrative there, like instead of finding a role for fossil fuels, but finding a role for themselves in the energy transition, would be a very strong argument to make, looking at the kind of financial structures that we're having here, right? Because banks are increasingly reluctant to lend to oil and gas projects. So I think there is that counter argument there that EPC companies and the potential of economic value they can derive if they started shifting to offshore projects. And hope that helps with the question.
Oh, that's great. Thank you, Jackie. And that's a great way to end. Unfortunately, we are out of time for this session, which just leaves me to thank our panel guests for joining us today and for stimulating such a great discussion on this very important topic. So Jacqueline, Gahi, and Yuna, thank you very much for your time. It's been a pleasure having you. And thank you to everyone who dialed in to join us today. If anyone joined late or would like to share the event with contacts or colleagues, a recording of the webinar will be made available on the Carbon Tracker website and social media in the next day or so. But thank you very much and goodbye.